talking about the magic of moving averages. Now, in tonight's presentation, I'm going to share with you a couple little short, or in tonight's webinar, I'm going to share with you a couple short presentations that I put together for you. When you see the recorded version of this class, you won't see the presentation because it doesn't re-record the presentations. So you'll see a blank spot. But if you wish to see these short little presentations that I'm going to share with you tonight, you can see those by going to YouTube and looking for the channel called Forex and CFD Education, and then look for the playlist for moving averages. Also, if you notice on your screen, I've shared with you tonight 3 special handouts that I put together for you. One is an excellent ebook from investing.com called Introduction to Technical Analysis. This is a great reference guide. I've also put together for you our moving average guide, which goes over everything we talk about in tonight's class with charts and explanations so that you have it for your reference at a later time. And then I've also given you one of the most famous or most well-known moving average strategies called Moving Average Convergence and Divergence, or MACD. And I've given you a guide on using MACD and how to set it up and use it in your trading. These handouts are only available during the live webinar. You cannot get them during the recorded classes. So you can see on your screen the 3 little download buttons. Please download those to whatever device you're using, and then you can move them around at your convenience to wherever you need to use them and read them. They're just straightforward PDF files. Now, in tonight's class, I'm going to use the term sometimes security. I might say asset. I might say Facebook. I might say Google. I might say the euro. I might say Bitcoin. But the fact is, I'm just mixing up terminology because it gets very, very boring saying security, security, security. But in fact, I'm referring to any publicly traded financial instrument in which there's an open market. Similarly, I intermix the terms investing and trading. Typically, an investor takes a long-term position, while a trader takes a much shorter-term position. Now, the fact is, investors use more fundamental analysis. They don't use technical analysis, and moving averages hold little value to somebody who's looking to buy something and put it away for a long-term investment. But these techniques apply primarily to trading, but do apply to all markets. So everybody asks me all the time, should I buy today? What do I think the prices will be tomorrow, next week, next year? Or what do I think they'll be in an hour from now? Now, wouldn't investing and trading be easy if we knew the answers to these simple questions? Well, to be honest with you, I don't have a Ouija board and I don't have a crystal ball. And anybody that tells you that is full of BS. So if you're attending this class in the hopes that technical analysis has the answer to these questions, I'm afraid I have to disappoint you earlier. It doesn't. However, if you're attending this webinar with the hope that technical analysis, especially moving averages, will improve your investing and trading, I have good news for you, it will. Because you have to remember, trading is less about analysis and more about risk management and money management. Your analysis gives you a filter system to filter down and out wasted trades, bad trades, and leave you behind only high probability trades. Okay. Technical analysis will help you decide where you need to put your stop loss, where to put your take profit, will help you decide when to enter the market. But ultimately, what makes you a champion trader is your risk management and your money management. Now, moving averages fall into a category that we know as technical analysis. The easiest way to define technical analysis, it's everything and anything you do on a chart. We could just call it chart analysis. Now, moving averages help Forex traders make effective transactions by aiding them in evaluating the price history of a currency pair or related investment. More specifically, these averages make it easier for investors to interpret the price fluctuations of an asset by smoothing out the random movements. Now, technical analysts have harnessed a wide range of indicators over time, but the moving average stands out due to being simple, practical, and useful. By using it, Forex traders can identify the price trends as well as support and resistance of the security in question. So let's pick up a chart. And I'm going to show you just how simple a moving average is. What we see right now is the current chart for the euro US dollar. I have it right now in candlesticks, but I'm going to switch it over to bar charts only because it's easier for you to see. Now, the purple line running through that is a 10-period simple moving average. Now, what's the first thing a moving average does? It takes the noise out of the random movements of the market. You know, trading is not something that's neat. A price chart isn't something that's concise and easy to see. It's a bunch of random moves and price moves that we're trying to interpret. We're also trying to only find when price is trading in non-random action, which happens very rarely. But when we have a solid uptrend or downtrend, that means that we're having the market's trend in non-random movements. It's making a very specific move that we can interpret. Otherwise, we have lots of noise. Now, a moving average simply takes that noise out. And there's a basic understanding of moving averages that anything above the moving average, okay, or we call it red light, green light. If price is below the moving average, you would only consider a sell scenario. If price is above the moving average, we would only consider a buy scenario. It also helps us define the trend, because even though we have erratic movement, we can now see with the moving average that it's trending down or trending up and see how price is relating to that average. Now, a moving average is a very, very simple thing. We can then put it into more complicated things, which is what we will do, but it starts out with something very simple. So a moving average is a type of lagging indicator that accumulates past price points and then averages them to provide a technical analyst with a better sense of where a security went over a period of time. Now, there are a handful of different moving averages, including simple moving averages and EMAs, or exponential moving averages. Now, a moving average is just an average. So if we were looking at a 15-minute chart and we wanted a simple moving average, or we would take say a 10-period moving average, we would take the close price of the last 10 minutes, of the last 10 bars on that chart for each 15 minutes, or we'd cover 150 minutes, and the close of each one of those bars, we would add those closes together and divide it by 10. And that would give us our simple moving average. Now, we could use a 20 period. We could use a 9 period. We're going to talk about how you determine what periods, but the periods have to do with trading styles and what you're trading. But it's whatever period we use. It's a simple average. And that's what gives us this purple line on the chart. Now, here we're looking at a simple 10-period moving average. Now, we could change that and we could use a 20 period, a 30, you'd use a 19, an 18, a 15, but you have to decide. Now, because we have advanced computerized charts today, things get a little bit difficult only because we have too many choices. Back when I first started trading 40 years ago, 45 years ago, we were doing everything by hand. And so the rule of thumb for a moving average is you always use the close of that period. Today, the computers will offer you, you can use the open, the high, the low, the close, the high low times 2, the high low 3. You can use so many choices, but all that does is make things very, very complex because it gives you too many choices. Basically, for a simple moving average, we want to use the close. Okay? You're going to find all kind of market gurus out there telling you use the open and the high and divide it by 2 and come up with that average, and that's what we're going to use in our moving average and plot it out. Well, this is something they're trying to influence you to use. But a simple moving average is really a base piece of information. Now, it makes the backbone of many, many different strategies. So for instance, Bollinger Bands uses a moving average and adds to it a formula called standard deviation. MACD uses, which is called the moving average convergence and divergence, uses 2 moving averages and the difference between those as the beginning basics of its MACD indicator. Okay. We also have moving average crossover strategies, and we'll talk about those a little bit more. But a moving average is a lagging indicator. Now, that's not necessarily a bad thing. It's not like leading and lagging, that like if somebody says your kid's lagging behind in class, or your kid's leading the class. Well, if he's leading in the class, he's doing very well. If he's lagging, he's doing poorly. Indicators are not that way. Leading and lagging are not good or bad connotations. Leading indicators predict what the market is about to do. Lagging indicators confirm that something has happened. That's the difference. One lags behind, one leads. But a lagging indicator can't help predict price movement in the future. It only confirms if a trend is ended, if it's trending, if something has happened, if momentum's been lost. So there are ways that we can use a moving average and move it to make it a little bit more valuable. Because we talked about this simple moving average. The simple moving average is just, we're looking at a 30-minute chart. It takes the close of each of those 30 minutes. And since we're using a 10-period moving average, it goes back 10 sets of bars. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Adds those closes together and then divides it by 10 and puts a dot on your chart. So to help give us a more defined answer and take away some of that lag, we have some other types of moving averages. And the most well-known is called an EMA. Now, an EMA, which I'm dropping on your chart right now, is the same 10 period that I'm using right now. And that's the gold line that's on your chart. Now you can see there's certain points in which an EMA and the simple moving average, the purple line, are quite far apart. And then a lot of times they're very close together. An EMA is an exponential moving average. What an EMA does, it gives more value or more weight to the most current price periods and less weight to the farther away periods. So in other words, a price that is current right now and a price that was 10 periods ago, when they're adding them together and dividing them, they don't just divide it because it gives more weight to that more current price. So it has more, it reacts faster to the market changes. And therefore, when the market is moving up or down, or has a lot of momentum, the EMA can be a lot more accurate than the SMA. Now, it's got a complex formula, but most of the time we use an EMA. So we talked about calculating a simple moving average, and the exponential moving average is giving more importance to the current price levels rather than the closing price of the candles that make up the period. So between the SMA and the exponential one, the EMA is much more accurate as it doesn't have that much lag time. So to calculate an EMA, and you'll never have to do this calculation, but calculating EMA is a bit more complicated than calculating an SMA because it uses what's called a multiplier. And the size of the multiplier depends on how long of a period we're using the EMA for. So basically, to calculate the multiplier, use the following formula. The multiplier is equal to 2 divided by the number of time periods. In our case, we're talking about 10. So it's 2 divided by 10 plus 1. So 2 divided by 10 is 1/5 plus 1. Okay, so for a 10-day EMA, it's 2 divided by 10 plus 1, or it's equal to 0.1818 or 18%. So this multiplier is giving more value by 18%. We're using a 20 period, same calculations, but it gives it more value by multiplying by 9.52. So once this multiplier has been acquired, we use the equation. We take the multiplier times the closing price minus the previous period's EMA plus the most current, or plus the previous EMA. And we do then our calculations. So an exponential weighted moving average puts more emphasis on current price rather than simple averages averaging the closing price. It reduces the lag by applying more weight to recent prices. So let me share with you a presentation that will hopefully explain it to you in a little bit. It's got a little bit of graphics and creativity to it. And then we'll come back. It's only a minute or two long. Now you might have to turn up your volume to hear this. I think I've raised the volume enough that you should be able to hear it just fine.
Is one of the most commonly used technical indicators. If you've spent even a little time looking at price charts, you will have noticed that most often the price of an instrument will move up and down. In fast-moving markets, you may find that the price may be surging up only to plummet moments later before surging up again, increasing the potential for false signals. The moving average can help filter out the noise from random price movements and smooth it out in order to see the average value. Moving averages are used to identify trends and confirm reversals. When the price is above the moving average line, we consider the instrument to be in an uptrend. Conversely, if the price is below the moving average line, we consider it to be in a downtrend. The breaking of the moving average line usually implies a trend reversal. Moving averages are also used to identify areas of support and resistance. Many traders will consider the moving average line as a support and resistance level indicator and base trades on it. So traders will check to see whether the price is going towards the moving average and see whether it will bounce back from it or break it, as with regular support and resistance level. Oftentimes, the price of an instrument will find support at the moving average line when the trend is up, and will find resistance at the moving average line when the trend is down. So moving averages will tell you whether an instrument is trending up, down, or if it's ranging. It can tell you if a trend is still in motion and whether it is reversing or losing momentum. Have in mind that a moving average is based on past prices and is known as a lagging indicator. Therefore, it will not warn you in advance, but it will confirm when a trend change has taken place. At the most basic level, when the price crosses up and over the moving average, traders take this as a signal to buy. When it crosses down under the moving average line, they consider it a signal to sell. Let's take a look at the types of moving averages. There are three main types: simple, weighted, and exponential. We will discuss the simple moving average, or SMA, first and show you how it's calculated so that you can adjust it according to the given market circumstance. So if you wanted to plot a 10-day simple moving average, you would add the closing prices of the last 10 days and divide by 10. This calculation gives equal weight to each day. It's called a moving average as the oldest price is dropped each time a new period becomes available, in this way ensuring that the average is based only on the last X number of periods, in our example for the last 10 days. Have in mind that the longer the simple moving average period, the more it lags and the slower it is to react to the most recent price movement. And this brings us to its downside. As equal weight is given to all periods considered in the calculation, the simple moving average is slower to respond to rapid price changes that might prove to be important. So how can you counter this? With another type of moving average, either a weighted or an exponential moving average. The weighted and exponential moving averages are calculated differently from one another, but both types give more weight to recent periods and thus more emphasis on what traders are doing at the moment. So as a result, weighted and exponential moving averages respond faster to price action by distributing more weight to recent periods and less to older periods. They reflect a quicker shift in sentiment, which can be due to changes in supply and demand or important news events that impact the traded instrument. To illustrate what we mean, if you were to plot an exponential moving average and a simple moving average on a chart, you will see that the exponential moving average is closer to the current price than the simple moving average. Apart from the type of moving average, you also have to decide on the time period. This will largely depend on the type of trend you are analyzing. Here are some guidelines for commonly used time periods: 10 to 20 for short-term trends, 50 for mid-term, and 200 for long-term trends are typically used. When and how should you use moving averages? Deciding which moving average to use and the time period will depend largely on your objective. Use exponential moving averages for shorter time frames, or if you're analyzing a fast-moving market, as you'd have more emphasis on the latest prices. Use simple moving averages if you are planning on holding a position for a longer period of time, as the exponential moving average might be too sensitive and give false signals. You should also use simple moving averages if you'd just like to filter out the noise from random price fluctuations to determine the overall market direction. Thank you for watching.
So volume weighted moving averages have been around for a long time. They are very rarely used, and personally I find them very inaccurate because they're trying to calculate and add in volume, and volume is a very iffy number because, like, if you're trading Bitcoin, there is no volume. If you're trading in Forex, the volume is based on what is going through the liquidity provider, and it could be not accurate with other liquidity providers. Stock market gives you actual volume, but remember, we're trading CFDs. We're not trading stocks on the stock market. So therefore, you'd have to be going to get your volume from somewhere else. So basically, we don't pay any attention to volume weighted moving averages because they don't work well for us. But then we come to a fairly new type of moving average. In fact, I've gotten that I like it so much that I actually teach a 1-hour class on displaced moving averages. It's a phenomenal, it's something that we didn't have. It's not that we didn't have it before. We didn't have the technology to be able to easily put it on our charts. So this is a relatively new concept in technical analysis. A displaced moving average indicator, known as a DMA, is nothing but a different simple moving average. So let me explain why. Traders found that multiple times price is slicing through various SMAs like there's no support and resistance. Then we see the price reacting from lower or higher levels, because the price moves very quickly today. And especially in us, where we're traders, we're trading in very small time periods. So we don't have the luxury of having long moving averages, because even if we're using a 20-period moving average, we're using a 15-minute chart, so we're only covering the last 20 times 15 minutes, or the last 300 minutes. So to overcome this, traders are cheating a bit. They're using the same moving average formula for an SMA or for an EMA, but shift the outcome forward or backward in time. What we do is we can tell our chart to plot the SMA 3 time frames forward. And this gives us some very interesting results. So we don't change the calculation. We take the same calculation for the SMA, but instead of putting it on the chart right here, we can plot it forward 3 periods, 5 periods, 10 periods, and we're finding that we get very, very reliable support and resistance levels and very good signals by doing this. So I've started using this to replace all my moving averages in my charts. I've even started using it for other formulas. And like I said, I present a 1-hour class on this once in a while because I really like what it is doing. It's simply using the same formulas, but giving us the advantage of technology to use that formula in a better way. So now once you've calculated one or more moving averages for security, there's a wide range of purposes, and many investors utilize these indicators to determine what trend a security is following. Because once we've calculated the moving average, we understand how to calculate it. What do we do with it? Okay, we can use it for some information. Okay, but what do we really do with it? Well, there's lots of ways that we can incorporate this into our trading. So let's talk. I'm going to share with you a little bit, another short presentation, and we're going to talk about some of the strategies that we can use moving average.
To identify the direction of a trend, how they can be used to enter and exit a trade, and finally, how to trade moving average crossovers. To determine the direction of a trend using a moving average, you must take into account the set time period. We touched on this briefly in the last video where we showed you the most commonly used time periods when analysing short-term, mid-term and long-term trends. But why is it important to be aware of the time period of the moving average? In this chart, when we place a 20-period simple moving average by clicking the indicator icon and setting the time period to 20, we can clearly see that it indicates an uptrend. Yet when we place a 60-period simple moving average in the same way, we see that it shows the price in a range with no clear upward or downward trend. The difference in the direction of the trend portrayed by the moving average is due to the time period. Shorter period moving averages are faster at generating signals, and changes in the price of the instrument will be reflected more quickly. The longer period moving average will react to price changes much more slowly, but will generally provide more reliable trading signals. As a trader, moving averages will help you decide which way to trade by looking at whether the price is above or below the moving average line. In this chart, the price is above the moving average line and acts as support. You could buy and enter a long position when the price pulls back to the moving average line. You could then place your stop loss underneath the moving average. Here we can see the opposite. The price is below the moving average and acts as resistance. You could then enter a sell order when the price retraces to the moving average line and place your stop loss above the moving average. The interesting thing about moving averages is that they can be used alone or in combination with other moving averages. So when you place two moving averages on one chart with different periods reflecting a short-term and a longer-term trend in price, you have the opportunity to trade moving average crossovers. They can be used to determine when a trend has changed direction. Let's show you what we mean. On a daily chart for the pound US dollar, we will now place a 10-period simple moving average and a 20-period simple moving average. When a shorter period moving average crosses above a longer period moving average, it can signal that the trend is changing direction to the upside and it may be a good time to buy. When a shorter period moving average crosses below a longer period moving average, this is considered bearish, a signal that the trend may be changing towards the downside and it may be a good time to sell. No matter which two times.
Now, a moving average crossover strategy is one of the oldest, most respected, but simplistic strategies we can apply. Okay. But before we talk about actually doing this, let's go over to the chart, because what I find is a lot of traders misunderstand when we talk about faster and slower moving averages. Okay. Now, what we're looking at is, let's get rid of my purple line, and we're going to go to a 10 period and a 30 period EMA. Now, that gives us two different exponential moving averages at two different periods. Okay. Now, what periods you use for a moving average crossover strategy varies by your trading. There's all types of different strategies out there, using a 10 and a 30, a 10 and a 20, a 9 and a 21. But they still are interpreted very the same. Now, the first thing that I notice is that traders get confused when we say faster and slower, because it doesn't have anything to do with the speed. The shorter period time range is always the faster. When you're using a shorter period time range, whether you're using 3 moving averages, however you're using average, the shorter the period, the more it's going to react to the most current prices. In other words, if we were using a 10 period simple moving average for gold, and gold was trading at 1250, 1250, 1250, 1250 the last 9 periods, and jumped up to 1275 in the last period, that 1275 is a very important number because the markets just reacted and just started doing something. So, but if we were to add together 1250, 1250 9 times back plus 1275, the moving average we would get would be, say, 1252, 1257, whatever the average would have been. Where if we were using a 5 period moving average, and we had 1250, 1250, 1250, 1250, and 1275, we would get probably a moving an average of 1265, because we're using a shorter period, so we're dividing it by the shorter time frame. So this makes whatever moving average you're using, the one with the shorter time period, the faster, only because it reacts faster to the most current market changes. The longer the period, the slower it reacts. Now, in a moving average crossover strategy, whenever the longer period and the shorter period cross over, it's going to give you a buy or a sell signal. So when your longer period moving average, your slower moving average, crosses the faster moving average and crosses below, it's giving you a sell signal. When it crosses and goes above, when it crosses and goes below, it's giving you a sell signal. When it crosses and goes above, it's giving you a buy signal. And there's many moving averages that use 3 different moving averages and a much longer period moving average, because then you could use a 30, a 60, and a 90. And as they fan out and separate, they tell you something very important about the markets. But this is one of the most basic moving average strategies out there. But if you're like me, I don't use very complex strategies. I'm only using strategies to give me a buy or a sell opportunity. Okay, and then I use filters. Okay, so my moving average crossover might give me a buy or a sell opportunity. Then I'm going to look at support and resistance. I'm going to look at a trend line, and I might look at volume and make my decision. I don't use I might use MACD now and then. I don't use RSI and stochastics. I don't use all the others. I do use chart patterns. So it just depends on what type of other parts of a technical analysis you want to use. Because again, what you're looking for is you want something that's going to give you or tell you a buy or sell alert. Then you want to start applying your filters to decide whether you want to even consider buying or selling. Then from there, you want to set, where you might get your stop loss or your swing of the market down and the move up, and then apply your risk management. So if a Forex trader can identify the momentum of a security, he can buy or sell the asset and even take out long or short positions on it To single out this momentum, an investor can look at what the financial instrument did within a short, a medium, and a long term. For example, if a Forex trader wanted to ascertain the short term momentum of the euro US dollar, he could look at either a 20-day or 20 period SMA or EMA. If he instead desired a better sense of a pair's long term momentum, he could look at a measure used of a period of 100 days or more. So we could use a longer period as an environmental signal that is going to tell us what the overall environment of that asset is, and a shorter period to tell us when to buy or sell. So another benefit of the moving averages is that they can be used to determine support and resistance. And the more ways we can determine support and resistance levels, and the more we can validate those levels, the more we're going to find opportunities. So many Forex traders will expect securities to find support once they reach key averages and use other indicators in order to back up their forecasts. In addition, these same investors will frequently make use of important averages to predict when currency pairs will run into resistance during their trends. Now, if an investor takes the time to master the moving average and the many benefits it provides, they'll have access to a wide range of tools that would not be able to harness otherwise. With these implements, Forex traders can make better informed decisions and increase their chances of meeting their objectives. So in theory, there are an infinite number of simple moving averages. If you were thinking to come up with some weird 46 SMA to beat the market, let me stop you now. It's important to use the most common SMAs because they've been tried and true. Really, the difference between a 40 and a 46 are very, very simple. Finding these weird ones, if you want to test all the market and back test and everything else, go for it. But there's been a billion people out there that have tried all this weird stuff. We found the most common SMAs and the most common EMAs are the ones that are most reliable. So while I do not advocate you following everyone else, it's important to know what other traders are looking at for clues. So some of the most popular is a 5-period SMA, and that really works for us when we want to find an actual entry point, but it's for a very hyper trader. It works very well for short-term trades. 10-period SMAs are popular with us and CFD traders, short-term traders. Then we can go to the 20-period SMA, and it's really the last stop on the bus for CFD traders, for short-term investors. But we also have the popular 50-period. And then we can go up to a 200-period. Okay. Now remember, these are reflected by the period, but also by the chart. Because if you're using a daily chart and you're using 200 SMA, you're going back 200 days. If you're using a 10-minute chart at 200 SMAs, you're going back 2,000 minutes divided by 60, 30 hours. So some traders will tell you to try simple moving average trading system where your buy or sell price breaks the average on a closing basis. Unfortunately, this is not accurate. Oftentimes, stocks will tick over or under moving averages only to continue in the primary direction of the trend. So now that I've given you just enough doubt before attempting to trade with a simple moving average, let's review a few ways to make money with SMAs. Because in the end, it comes down to what you feel comfortable with and what your trading style is. So let's take a look at some strategies using moving averages.
I want to point out that this is something that works in all time frames, so you day traders might want to incorporate this as well. It actually works quite well for day trading as well. A lot of times I will run just a single moving average line on my chart. I tend to use a longer moving average line like a 55 or perhaps a 60, and if the market is above my moving average line, I consider it to be bullish, and below the moving average line, I consider the market to be bearish. Just a very simplified uh, indicator to tell you what the market is doing. You can also look at the moving average line itself. If the moving average line is moving down, well, of course, the market is bearish. If the moving average line is moving sideways, and you'll be surprised how often this happens if you look for it, you'll know the market is neutral and it's a good time to avoid it. And then, of course, if the moving average line is moving higher, the market is bullish and we should be looking to buy. I also like to put a second moving average line on the chart on occasion. And my line of preference, and actually coincidentally Rob's line of preference, is also the 20 moving average line, the 20 period moving average line. This works great on a daily basis, but it has merits for an intraday basis as well. From a daily point of view, there's 20 trading days in a month, so the 20 period moving average line roughly represents the monthly trend. You can see it's a little bit more responsive. It follows prices more closely. But here's the principle I want to share with you. When prices are below both lines, then that is the time to consider a trade. If prices are above both lines, that is a time to consider a trade. However, when prices are between the lines, as they are back here, or as they are here, or as they are right here, these are the times to avoid a trade. Now, on a daily chart, these regions are rarely as large as they will be on an intraday basis. Rob even coined the phrase abattoir, which is French for slaughterhouse, because that's where a lot of traders end up getting killed. Why? Well, simply because the market has no defined direction. When prices are trading in between the moving average lines, what is that telling you? If we changed this and put, say, a 5-period moving average on here as well, let me see if I can delete the... Okay, here's your chart without any bars on it, just your moving average lines. The turquoise being the 5-period, the 20, and the 55. Well, here it is in between your 20 and your 55. So what is that telling you? That's telling you you have a market that has no real direction to it. Here the market has direction. The 5 is below the 20 is below the 55. Prices are going down. Here the market has direction. The 5 is above the 20 is above the 55. The market is moving up. And likewise here, we have direction. But here, what do we have here? We have nothing. We have a jumble of information. Now, I know there's different ways that you can trade these moving average lines and such, and we're not going to get into that into this lesson. But I just wanted to show you that when the market is trading between the moving average lines, that might be a time to avoid it. Let me eliminate one of these lines here so it gets less confusing. All right, so let's take a look here. What would happen if we had paid attention to that? All right, we would not have taken the signal anywhere through here because the market did not have any defined direction to it. So where do we next see support come into the market? Well, we see support right around here, don't we? With our red-green bar combination. And we would have had a buy signal and a nice little run ensue from there. What happens after that? Well, the market falls back down here. It's in between our moving average lines. So do we take this signal? Well, if we did, we would have got lucky. And actually, come to think of it, I think I did take this signal. But you can see that they won't always work out. And I'm going to point that out to you a little bit later. This signal is a higher risk signal than you would have gotten, say, off of the support signal up here, or certainly the support signal right through here. This would have been a much more predictable move. This is how you can judge which trades will be more risky and which trades will be less risky. Once again, the prices fall between the moving average lines, so you would avoid taking a trade anywhere through here. Your next support signal comes right here, and look at that, that's right at the beginning of the run. Sure, you didn't catch it way down here from the low, but who cares? You don't look to catch to buy the lowest point or to sell the highest point. That's not feasible. You may do it from time to time, but you can't do it time and again. Okay, so you would have caught a nice little run here. Let's take a look.
So as you can see, moving averages are a multifaceted tool that can be used in a variety of different ways. Once a trader understands the implication of EMA versus SMA, the importance of the self-fulfilling prophecy, and how to pick the right time periods, moving averages become an important tool in your toolbox. Now, the fact is, moving averages the calculations are easy. The understanding of moving averages is easy. The application of moving average crossovers or adding into the MACD indicator or the Bollinger Band indicator are pretty easy also. So it's one of the few tools that's very easy to incorporate into your trading every day without spending years learning how to master it. So if you're new to trading and want to start out with a simple strategy, start becoming an expert with using a moving average crossover strategy. Start using just a basic SMA or an EMA to determine trends and whether you should be in the red light, green light area. Always use it, only buy above, only sell below. Okay, just general information that will keep you on the right side of market moves. So thank you very much for joining us. And if you want to learn more about moving averages and the strategies, check out trade.com's education center, and they have all types of books and videos on each segment of moving averages, or they'll talk to you one-on-one and help explain these strategies to get you off on the right foot. So again, go to www.trade.com and enroll in their education center, and you'll be in no time at all, you'll understand how to use moving averages. So have a great time tonight. Have a good week, and thank you again for joining us. Bye now.